at the results for 2023 and the outlook for 2024. And if I can have my screen up, that would be great. Fantastic. Good. So we'll start with looking at the group. So Standard Chartered Bank, as you know, we are a group entity and we've got presence in many parts of the world. And I'll be able to talk to you about the results that we have delivered, which we announced on Friday as Standard Chartered Bank Group. I'll also narrow it down to Africa and the Middle East. As Zambia, we fall under Africa and the Middle East region. And after that, I'll go further to talk about our results right here in Zambia. So let's start with the group. Income was $17.4 billion. And as you can see on the screen, this was 13% up year on year. And when it comes to profit before tax, it was $5.7 billion. And that, again, as you can see, it was an increase of 27% year on year. There's one metric that is very critical to our investors, and we've been looking at this metric for a very long time, and we have been targeting to cross the 10% mark. We have been working on this for a very long time, and I am very delighted that after a long time of hard work, Standard Chartered Bank Group has finally achieved a 10.1% on return on tangible equity. Now that is on the group results. We'll move on to the Africa and the Middle East results. For Africa and the Middle East, we have our income was up by 26%. If you remember, the group was 13% up. Africa and the Middle East, in terms of year on year, did excellent. Very, very good. 26%, and that was $2.8 billion for 2023.
Greetings everyone, my name is Serek Chuma for Financial Insight Zambia, here at the quarterly briefing of 2023 and 2024 outlook by Standard Chartered Bank Zambia. Joining me is the CEO for Standard Chartered Bank Zambia, Sonny Zulu. Sonny, how are you doing?
Very good. How are you doing?
I'm good,
Awesome.
good. So are you able to tell us about the results for 2023 and what you've just come from presenting?
Yeah, sure. So 2023 was a very good year for Standard Chartered Bank, both at group level and in Zambia as well. I'll include the region as well. So at group level, the bank posted over $17 billion in income. That was 13% growth year on year. We also are very delighted that we managed to achieve our return on tangible equity of 10.1%. This is something that we've been looking to achieve in a very, very long time. Here in Zambia, our income grew by 27%. The last time we had that growth was in 2013. So this has been a major turnaround for us. Our profit on the other end, profit before tax, grew by 145%. That is again very, very outstanding, and it is gratifying to note that this is happening at a time when we still have a lot of challenges economically. So we believe that as things are turning around, we can actually do more. I'm particularly delighted with our loan book, which grew by 63%. From a strategy perspective, our strategy is working. We are happy with our digital strategy and the progress that we have made. We are also happy with the transformation that has been delivered from a client experience perspective.
Also, the bank's strategy is really focused more on digital, and you've said 100% of onboarding of our clients is now digitally done.
Sure.
And 74% adoption rate. That's quite remarkable.
Absolutely.
Very, very remarkable. Are you able to outline some of the key initiatives that you actually employ to make this as seamless as possible, and that has resulted in you having so much success?
Yeah, so there's a lot. First of all, it's really about mindset change. We ensure that we always think digital. We try as much as possible to digitize every process and remove manual intervention. I was giving an example earlier that, for example, in my own office, I don't allow paper at all. There's no paper. It's a zero paper office. Even my business cards, I have one that I can just tap and the number comes onto your phone. You don't even have to scan the QR code. It's just by tapping and the number comes there. But these technologies are available, so it's not really a Sunny technology. It's just that I've adopted it. These are technologies that are available. But when we begin to adopt them, and everybody gets convinced that you can actually sign a document and it will be valid digitally, then the mindset begins to change. From our client's perspective, we've been doing a lot of education. We have a lot of how-to videos that we send to clients, just showing them how to be able to use the different services. Today we have got over 72 service requests or service journeys that can be performed digitally. So for a number of services that people would come to the branch before, requesting for a card, requesting for a checkbook, wanting to cancel something, all of that can be done digitally. So at the beginning, I think we noted that there was a lack of knowledge. Customers were not aware. It was in their hands, but they were not aware. But with our sensitization that we have been doing, sharing with clients, and also taking away all those barriers like charges and fees, we have seen more and more clients. Today, we have got over 92% of financial transactions being performed digitally. We also have over 85% of service requests being performed digitally as well.
Now, how have you managed to achieve this? I am very delighted, ladies and gentlemen, that our digital strategy has been working. And it's been working very, very well. If you look at our digital adoption, currently sitting at 74%, that is digital adoption. When it comes to service requests, 85% of all requests today are being processed digitally, meaning that wherever the clients are, all the services that they're requesting for, 85% of these are being processed digitally. What about financial transactions? 92% of all financial transactions are being processed digitally. You may be wondering to say, how is Standard Chartered Bank managing to service all these clients with only 3 branches? The answer is digital. Now, I'm here as CEO. I cannot be able to do this on my own. It is this wonderful team that has been delivering all this success. And the one thing that you notice about this team here, this is my management team. If you look at this team, we've been trying to get to 50-50 on gender diversity, and I am super delighted that we have achieved that 50-50. For those that can count, please, you can count, and you can see that probably we even have more female than male on our team. I'm also delighted that for the very first time in 118 years, we have the first female board chairperson for Standard Chartered. And with this team, I know that we can only but continue to succeed. And all of these awards that we got last year, really a testament of the great work that this team has been able to deliver. I am particularly delighted with the first one, which is the Client Experience Award. Standard Chartered Bank being recognized as the best customer service bank in Zambia. We must also commend the central bank for the steps taken. We know that the impact of this is felt by everyone, but some of these we are seeing them beginning to yield some results by increasing the statutory reserve ratio, In as much as banks, it affects us in many ways. But we can see that it begins to reduce the availability of the local currency, which is chasing after a few dollars. And that helped to ensure there was some relief on the local currency. The government has also come up with another initiative to mop all deposits for government institutions, agencies, entities, and put them in one central account. That is mopping out the kwacha liquidity from the market, and the less kwacha is there in the market chasing after a few dollars gives relief to the local currency. A few things to watch out. I'll talk about interest rates. So if you look at interest rates, MPR has been going up. In January, we were at 11%, and as we are getting into February, we got to 12.5%. There will be a few things that we need to consider as we continue in this year. On one hand, to try and reduce the impact of inflation, the interest rates will be going up. The fact also that the statutory reserve ratio has been increased to 26% means that there's little liquidity to give out to customers for loans and advances. And if there's little liquidity, there will be pressure on deposits. So you'll see that financial institutions will begin to pay up more to be able to attract deposits in the system, because 26% has been locked up in the statutory reserves, and also because a big portion of government deposits have also been mopped out of the system to sit in the central account. So to attract more deposits, there will be pressure on rates, and as you are paying up on deposits, that will also move to the loan or the lending side. So you see the pressure on interest rates from that angle. The last auctions on T-bills were undersubscribed, and if there is an undersubscription, if the government will still need money over the period, there will be pressure to increase the rates. In the last subscriptions, the ones who had quoted higher, those bids were rejected. But we have to see this from another angle as well. The fact that the government is beginning to mop up deposits and putting them in a central account, the demand from the government will be much less, because the government will no longer be coming at the same level to the market to borrow for bonds and T-bills, because they can be able to use their own money which they have put in one central account. So what do we expect to see given these conflicting situations that I've just shared with you? In the immediate term, we may be able to see pressure on interest rates going up. But in the medium to long term, we should be able to see a correction or a relaxation as the government's demand for bonds and T-bills will be much, much less. And as that is going down, it should be able to come back into equilibrium, and the rates should be able to come back again down. In terms of the timelines, this is something that we are yet to see. With that, I just want to share with you a few final thoughts, maybe just one or two. We are very confident about the outlook for 2024. We are also confident looking at the actions that are being taken by the government and the actions that are being taken by the central bank. It is also very important for us to note that these actions may not yield results immediately. Some of these actions, the results will be able to see them in the medium term and probably even in the long term. Especially when we talk about the area of mining. Mining is a long-term initiative. Even the actions that have been taken now, you see the benefits coming in the medium to long term. There might be some immediate benefits that you'll be able to see, from the direct investments that is coming in. But the material, substantial impact, we should be able to see this in the medium to long term. What does this mean for us? What does it mean for you? What does it mean for somebody who is out there? It means that we need to remain focused. We need to remain focused on the agenda and not to be distracted and not to be distracted. We know there are so many external events and activities that do happen. But the moment we distract ourselves, you find that even the efforts that collectively as a country we are making may not be able to yield results. So if there's any message that should be sent out to every Zambian, every person out there, is that with a vision that is clear, it is very important for us to focus on that vision, run with that vision, and ensure that we remain consistent for us to be able to see the results. The inconsistencies that we have seen in the past, where you start, stop, will not be able to help us to come out of our current economic challenges. And when it comes to profit before tax, for Africa and the Middle East, it was 90% growth year on year, coming out at $1.3 billion. And for return on tangible equity, if you remember, the group did 10.1, Africa and the Middle East did 16.6%. Now, we've told you about the group, we've told you about Africa and the Middle East, and now we are coming on to Zambia. Zambia, after a very long time, we posted an income of 1.5 billion kwacha for 2023, and that was 27% growth year on year. We have not achieved this kind of growth since 2013. When it comes to profit before tax, that was, for the first time again, 918 million kwacha, representing a 145% growth year on year. We've gone into history and we could not find a time when our profit grew by this level. And looking at the other metrics that we looked at for the group and also for Africa and the Middle East, our return on tangible equity was 14.3%. This was a turnaround from the previous year when it was negative. In fact, it was negative 0.2%. When it comes to cost-income ratio, I am very delighted that we have improved our efficiency. Last year, we were at 70% cost-income ratio, and we posted in 2023 55% cost-income ratio. Returns on equity, which we usually look at, and for investors are interested in this, we posted 43%, and this was again growth from the previous year where it was 25%. Now, how have we managed to achieve this? I am very delighted, ladies and gentlemen, that our digital strategy has been working. And it's been working very, very well. If you look at our digital adoption, currently sitting at 74%, that is digital adoption. When it comes to service requests, 85% of all requests today are being processed digitally. Exchange rate. This is how exchange rate has performed. I think it was almost at its worst on the 4th of February when it was about 27.42. The question that we usually get, I get that as CEO, we get that as bankers, should I buy or should I sell? The truth is no one can tell you. Because no one knows exactly what will happen. There are so many things that are at play when it comes to exchange rate. We can be able to forecast, but the last thing we want to encourage anyone to do is to speculate. By all means, avoid speculation. And sometimes when statements are made, people begin to speculate and they begin to move funds. Speculation will only last, the impact will only last for a few days. There has to be a structural movement for that to be sustained. There are a few things though that we want to point out that is affecting the exchange rate and will continue to affect the exchange rate. Number one, it's mining. We know that mining has been contributing about 70 to 75% of all foreign exchange income. With a slowdown, especially from some of our key mines, that is affecting the flow of foreign currency in the country. If you look at it in comparative terms, you might say, look, the movement has not really been that, it has been more static, but remember that the demands on many other sides have been going up. So if we are not growing our exports in the mining sector, which is the biggest contributor, will continue to be under pressure. We are so excited, I must say, of the prospects and the pronouncements that have been made and the commitments that have been made, and we are very confident that in the medium term, we should be able to see a huge benefit coming in from the investments that are being made and the announcements that are being made, and also the decisions that have been taken on KCM, on Mopani, and Lumambe. The other one that will impact foreign exchange is oil importation. Many times, the biggest demand is coming from oil marketing companies. As we all buy new cars, and as we all drive, and as new petrol stations are coming up, the demand for fuel is going up, and it's not also helping. When you see the fuel prices going up on the other side, the demand becomes even higher. There are also some other areas as well, like manufacturing, which has kind of remained static, and in some cases declined a bit. As long as we continue to import, our local currency will be under pressure.
And also you spoke about the macroeconomy as well and focus on the exchange rate of our currency. You mentioned several key sectors such as mining that impact the exchange rate as well. And recently we had the announcement of the public credit agreement between India and China, which was one of the final pieces. Are you able to outline just what that does for the country and how that helps you as an institution create more value as well?
Fantastic. I think one thing we need to understand about the public credit agreement is that, you see, most of these bilateral lenders are part of the OCC. The president did a very good job in leading those negotiations, especially in the last leg, to ensure that that happens. But when the agreement is done, it is expected that the parties will have to come and sign the agreement. So it was really cementing what was achieved. And it was good, because sometimes some agreement would be there, but people have actually not signed. So it is hanging somewhere. But by coming to a place where we are seeing now these countries have actually signed, it then makes whatever agreement was made concrete, because now we know that this has been. So that was very good. But in terms of looking at what this does, it's very important for us to know that once the restructuring conversations are making, are taking steps forward, it's actually very good for the economy. We still have part of the restructuring conversations still ongoing, yet to be completed. We are keen to see the completion of those conversations, because there is some foreign direct investment that will only be able to come in after we have completed that. Because whether we like it or not, there will be those that are still standing on the fence, not really sure, because they don't know how long it's going to take and the impact if this delays for a very long time. So in the meantime, I think what has been done was done, and we are very delighted and happy, and we are seeing the positive impact of that. The bond holders, that has yet to be finalized, and the private lenders, that has to be finalized as well. We are confident that with the progress that is being made, that should be close. From a foreign exchange perspective, it is very difficult really to tell where the foreign currency rate will be, because there are so many moving parts. I think what is encouraging is to note that the right decisions are being made. So if you look at those drastic decisions that were taken by the central bank, they yielded some results, and they'll continue to monitor that. I think the governor is very clear that the central bank will do what it takes to ensure that they help to stabilize. With the increase of the statutory reserve ratio, it has reduced the amount of liquidity that is there chasing after the dollar. But the other side as well, we have to acknowledge that it has also reduced the amount of liquidity available to give out loans. So that is something that we have to watch out for, because as there is a pressure on liquidity, then you see pressure on interest rates beginning to rise. It has got another effect that might, be unintended, but also good for the economy, in that as that is happening, then it also begins to reduce inflation. Because the more liquidity you have in the market, the lower the rates you have in the market, the more access to funding people have, then the higher the inflation. So we should be able to see that helping to cushion inflation as well. I think the real answer to this is for us to buy more Zambian, for us to focus more on the manufacturing sector, for us to reduce on imports and focus more on exports. Exports should never be looked at. I wish we could come to a time whereby we have enough maize to export and we don't stop that. We have enough electricity to export and we don't stop that. Because if we can do that, that's the only way that we'll be able to see, foreign exchange coming in, because that is structural. When you do that, you have the foreign currency coming in and it stays in the country. You don't have to go out again to go and do your imports.
Yeah, and also we saw the bank have a decrease in the cost-to-income ratio from 70% to 55%, which is quite remarkable, showing that you have improved on the efficiency of the bank. Sure. What are some of the strategies that you employ to reach this particular result?
One of them is clear. It's obviously we reduce the branch network. That is yielding results. But we reduce the branch network without reducing the services. So transactions have gone up, number of customers have gone up, our asset book has gone up. So we took out the cost, but still provided the service to the client. And also, the reality is, doing things digitally is much cheaper. Yeah, so we have got less paper, shorter processing time. It's much cheaper to do things digitally. And that's why even our fees and charges are relatively on the lower side. For most of the digital transactions, we don't charge anything at all, because it's much cheaper to do that. So yeah, so our cost-income ratio has improved from the 70% that it was previously to now 55%.
It's been amazing. So it's been a pleasure having you. Thank you so much.
Thank you so much. Really appreciate it. Thank you so much. Thank you.
Thank you.
Awesome.